Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. This is our update for October 11th, 2022. I'm Ken Adamo, Chief of Analytics over here at DAT, and making his triumphant return, we have Dean Croak joining us, who's our Principal Industry Analyst. Good morning, Dean.
Good morning. Good to be back. It's been a few weeks.
It has. We were together live in Austin last week. It was a tremendous event at DATCon, didn't you think?
Yeah, I did. It was one of the great conferences I've been to. So it's so good to be back out, mingling with our customers again, learning about what issues they're facing. I was pleasantly surprised about how many folks watched this show. I was
it was our first time ever having shippers together with brokers and carriers. It was a really great event. Again, it's a more intimate event, right? Because it's more of our users, people using the product day in and day out. We also had our customer advisory board inaugural meeting. So it was a really, really good time. Great weather, great food. Super proud of our team. And like you said, I'm always energized to get out there with our customers. Also a great weekend for the Buckeyes, trouncing Michigan State up there to our north. We were originally going to have Matthew Leffler on this week, the armchair attorney, but given the logistics of everything, we thought it was best to save Matthew for next week. So FYI, Matthew Leffler, the armchair attorney, will be joining us next week. So save all of your legal questions. I know he's coming poised with 3 really great topics to discuss, so I'm looking forward to that. With that, I'm going to get into our key points of the week because we have a lot going on to discuss. All right, so van, reefer, and flatbed spot rates are tracking since this was posted, nearly 10 cents higher than 2018 levels. I think that's really good news. You're probably seeing some bump from the hurricane and some stronger than anticipated retail shipping. Equipment posts identical to 2019 levels and just 9% lower than April of 20. We're humming right along, averaging about 1.25 million dry van load posts per week. That's a key indicator for us of health of the spot market. And again, that's double the prior average that we saw before the pandemic. Florida inbound, Dean's going to cover this in a lot more detail, but you're definitely seeing regional impacts of Hurricane Ian. Imports slowing, and I think a lot of the big story there is around port shifts. And then ACT Research, the firm with which we launched our partnership, and Tim Denoyer joined us for a wonderful panel at DATCon, shows that September Class 8 truck orders are the highest ever on record. So with that, I'm going to turn over to Dean for our market update. Dean?
Yeah, thanks, Ken. Last week we had 1 million load posts in dry van for the 4th week in a row, even though load post volumes were down a couple of points. It was an interesting data point. Load post volumes have been very healthy. They've only been lower than 1 million load posts per week in 15 of the last 123 weeks. Speaking to how healthy the dry van spot market is. Compared to the average weekly load post, it was about 612,000 loads before the pandemic. It's up over 1.2 million consistently now. Equipment posts, though, different story. They were up 5% last week. Capacity loosened slightly. We're still seeing capacity enter the markets. It's very close to 2019 levels when the market was oversupplied. So as a result of fewer load posts and more equipment posts last week, the dry van load to truck ratio decreased slightly from 3.77 to 3.51. Having a look at the refrigerated market, load posts were up 10% last week, but still down 41% compared to this time last year. Load posts in the reefer market are up also compared to pre-pandemic averages, not quite as high as dry van. They're about 700,000 a week since June 2020, but about 1.8 times what it was going back to 2016 before the pandemic hit. Again, capacity in terms of equipment posts flat last week, but still at the highest levels in the previous 6 years in the refrigerated category. Capacity is still pretty loose there. Load to truck ratio relatively unchanged at 6.61 last week. And in flatbed, load posts jumped last week, up 13% last week, boosted by a surge in Florida inbound volumes following Hurricane Ian. Inbound volumes into Florida were up 113% last week. But overall volumes are still a long way off last year's levels. They're around 60% lower last week in terms of load posts. Capacity still loose. Equipment posts were up 8% last week and still at the highest level in the previous 6 years at the start of October. So as a result of last week's movement in load posts and equipment posts, the load to truck ratio up slightly to 14.30. Having a look around our markets with our market condition index, focusing on the southeast last week, a lot of dry van activity was focused on the rebuilding efforts following Hurricane Ian. The prior week, we reported that we saw a lot of volume being staged in markets just north of Florida. That volume moved into Florida last week as the infrastructure started to improve. All four freight markets volumes were up by about 27% last week into each of the markets as an average. Lakeland, which was the hardest hit market, inbound load posts were up 34% last week. Rates up 3 cents a mile to $1.23 for all Florida outbound loads. Not a lot of movement on the outbound side. Lakeland was the biggest market where we saw rate movement. A lot of inbound volume to Lakeland came from Atlanta last week. Volumes on that particular lane, Lakeland to Atlanta, dry van were up 42%. That's loads moved, not loads posted. A 42% week over week increase out of the big distribution market in Atlanta. Rates on that lane at $3.03, about 18 cents a mile higher than the September average. Other inbound lanes into Florida include Charlotte to Lakeland. Spot rates are up to $2.83. That's up 24 cents a mile higher than the prior month's average after being flat since May this year. And as expected, capacity tightened in the Southeast primary distribution market in Atlanta. We covered that on the show last week. Outbound spot rates in Atlanta up 7 cents to an average of $1.87. Similar trend reported in nearby Savannah. Having a look at the refrigerated market, again, wrapping up the impact of Hurricane Ian. Outbound spot rates from Florida in the refrigerated market up 7 cents to an average of $1.29. Load posts outbound were up 5% last week, much lower than the prior week's 24% week over week gain as shippers rushed to shift freight out of the way of the hurricane prior to landfall. Inbound load posts were up 22% last week into Florida overall. In the hardest hit freight market in Lakeland, inbound load posts were up 27% last week. Most of that volume again coming from Atlanta, as we covered in the dry van sector. Along the southern border, produce volumes are down almost 3% compared to this time last year, but reefer capacity was tight last week. There was a 1% increase in load posts, but a 7% increase in reefer spot rates. Outbound loads averaged $2.10 per mile in Laredo and McAllen markets, while loads to Lakeland from McAllen and Miami averaged $2.71 and $2.38 respectively. That's Lakeland to Miami and McAllen to Miami. Both lanes were up by about 20 cents per mile last week compared to the average in September. And again, in Chicago, capacity continues to tighten. Even though load posts were only up by 1% last week, outbound reefer rates in Chicago were up 8 cents a mile to an average of $2.83, slightly higher at $2.87 in nearby Joliet. And wrapping up the market condition index in Lakeland, Florida, again, Hurricane Ian made landfall in Lakeland. That was the most impacted market. Inbound load post flatbed up substantially into that market, well over 100%. A significant amount of that volume came from Dallas. Spot rates from Dallas to Lakeland were up almost 20 cents a mile to $1.97 last week. Outbound load posts in Lakeland, which is a pretty big flatbed market for DAT, load posts were up 16% last week as the market slowly recovers. Outbound spot rates in Lakeland up to $1.74 per mile. Some of that volume we were seeing in Lakeland was coming in from Memphis, the logistics hub of America. Outbound flatbed rates were up 5 cents a mile in Memphis, averaging $2.78. And having a look at some of those lanes out of Memphis, one of the other lanes that a lot of volume moved to was Chattanooga. Capacity tightened on that lane. Rates were up 12 cents a mile above the September average at $2.83. That's after being flat for the prior 2 months. And again, in the Pacific Northwest, lots of activity for flatbed carriers. Load posts were down slightly, but capacity was tight. Rates out of Medford were up 9 cents a mile. It's our biggest flatbed market in the Pacific Northwest. Rates are averaging $2.63 for all outbound loads. One of the lanes that was particularly busy was Medford to Albuquerque. Rates are up 13 cents a mile to $2.26 last week, although that's still 18 cents a mile lower than the previous year. So having a look at our year over year, look at spot rates, one of the questions we were asked by a number of folks in the media was why didn't Hurricane Ian move the national needle? It hasn't had a material impact, although in that region we've seen a lot of activity in terms of spot rates that we've just covered. The national average spot rate ended last week at $1.88 per mile. Not a lot of movement up or down, a little bit of movement over the course of the week, but essentially was flat at $1.88 excluding fuel. Remember, these are line haul rates excluding the fuel surcharge. Compared to the top 50 dry van lanes for loads moved, they averaged $2.23 per mile last week. That's about 35 cents per mile higher than the national average for dry vans. Dry van rates still 62 cents a mile lower than this time last year, but about 22 cents per mile higher than the average for the 4 prior pre-pandemic years for the beginning of October. And having a look at refrigerated, again, flat last week, remaining at a national average of just under $2.19 a mile. That's 71 cents per mile lower than this time last year. Reefer rates have decreased by about 31% since the start of the year. At the beginning of October, they're just 7 cents per mile higher than this time in 2018, maybe slightly higher by the end of this week, as Ken mentioned. However, last week's average spot rate is still 23 cents per mile higher than the pre-pandemic average of the 4 years prior to March 2020. Having a look at flatbed now, wrapping up our market update, spot rates remained flat last week, boosted by increased load board activity in the southern region. Hurricane Ian obviously had a fairly big impact in the flatbed market. In the southeast, although rates are not materially up, they ended last week at $2.18, still 18 cents per mile lower than this time last year, and about 8 cents per mile higher than the pretty good year flatbed carriers had in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published this evening. And with that, it's over to Ken for the short-term forecast.
Thanks, Dean. Appreciate it. And I forgot to mention earlier in the show, I wanted to give a special shout out to Alex Perry for covering for the incomparable Dean Croak over the last few weeks. That's a tough seat to fill. All right, so let's talk about short-term forecasts. And I've got a bit of a mea culpa here because woe is the executive that questions the Raycast model, apparently. You've heard me talk for several weeks leading up to this show about questioning Raycast's optimism, and it turns out to be about as spot on as a forecast could possibly be over the last few weeks. So you see here the blue line, if you're new to the show, new to this chart, is the historical 7-day weighted moving average. This happens to be dry van actuals. It's long haul only, excluding fuel. And then you have a bunch of forecasts. You have green, which is Ratecast. It's what's available in all of our products. And then you have the red, which is a short-term weighted forecast. It's going to look at recent history and weight that heavier. And then you have a yellow and a gray line, which are blends of the two. What I'll say here is essentially Ratecast being right and the market behaving as expected for once kind of smushed all the forecasts back into agreement about what the next, 35 to 40 days has in store for us, right? So it's very important to look at that x-axis. We're peaking into November here, and that's a horrible dad pun. But the reason I bring that up is that's when we'll start to see that final push heading into Black Friday is kind of the start of November on. So that short-term forecast is getting real optimistic towards the end, right? It kind of senses that retail peak coming, and Raycast is taking a little bit more of a conservative approach. But all in all, pretty well in alignment. Let's go to reefer. Even more in alignment, right? So I think what you'll see here a little bit is that short-term pessimism from Raycast is just being bred from this typical slow period where things maybe are moving in private networks or dedicated throughout the supply chain, getting ready for Thanksgiving. The rest of the forecasts are almost in extreme agreement. And again, that's when you start to see them diverge as we head into the very start of November. But a very similar chart to dry van. Flatbed's interesting as we end here. It's sort of stopped to the tailspin than it was in a bit. And the contracts, the forecasts are in rather tight agreement for the first time in, I would say, a couple of months, to be quite honest with you. So it seems to be that it pulled a bit out of its rut. That makes sense. You would expect a hurricane like that to have a larger national impact on rates on the flatbed side than you would on dry van or reefer. So we're going to continue to monitor this because I think if you start to see that blue line tipping down and the forecast being a little bit incorrect, you'll start to see those different models disagree. But all in all, 3 forecasts, 3 equipment types, 3 models, ensemble models in relative agreement, things behaving somewhat close to normal. That should be a welcome sign of relief for those moving freight out there and pricing freight. So with that, we are going to go to our question of the week. Dean?
Yeah, big question this week. Of course, there's been a lot of talk in the news about excessive inventories. So today we're asking, will there be a peak shipping season this fall? It's a good question. We've been talking on the show about this, Ken, for a while. I've been theorizing that we've already seen peak shipping season, certainly on the ocean side. I think that's pretty evident by the drop-off in volumes that we're starting to see and the definite cooling in that market. I have to say, Ken, I don't know whether you agree or disagree, but it feels like we've already seen peak shipping season in trucking. We talked about this at DATCon, where we thought things would be relatively flat between now and the end of the year. So interested in your take on that. My take is that I think we've seen the peak already.
Well, I think we may have seen the peak in rates, but I think you're definitely going to see that cluster of volume that happens from Black Friday to Christmas. I mean, that's going to blow the volume. Right. Honestly, in industry, like when we're looking at analytics, we typically hide the first two and the last 2 weeks of the year because it blows out the axis. So, I mean, if you are at all exposed to retail, or you kind of have freight moving in retail markets like Harrisburg or Memphis or Louisville and Dallas, you're going to see a peak volume. I don't know that we'll see rates peak much above where they are. Peak is always sort of like a dromedary camel. That's the one with two humps, right? I'm trying to remember. So you always see that. We tend to lose in the spot market visibility to that freight or access to that freight. When it lands and goes like that first mile, there's a ton of spot freight involved in the retail peak. And then we lose it for a month and a half. And then it picks back up in that final mile, not direct to consumer final mile, but maybe warehouse to retail, or sort of the way that it moves around close to delivery. So I think we'll still see that from a peak volume standpoint. I don't know how much uplift it's going to provide to rates. But with fuel coming down so much, you might see more upward mobility in rates. I wouldn't be surprised if we did see a bit of a boost to rates heading into Christmas.
Right. Ken, you make a good point. Some of those lanes where a lot of that warehouse freight is staged will definitely see some increased volumes, like especially Harrisburg, Allentown market that services a lot of the the Northeast and Mid-Atlantic markets. A lot of inventory though, right? So we've got a lot of inventory built up. Some of that'll be, replenishment volumes moving to retail stores. It's a little bit different than the inbound longer haul side of the market. So definitely, Nike reported this week, it was a great story in Supply Chain Dive. At the end of Q2 this year, their inventory levels were up 44%. One of the statements the CEO made that got my attention, and I think a lot of people are feeling this, they said that some apparel arrived late and some arrived early. So we could see some particular port lanes impacted by that, some of the backlog of ships.
Yeah, I mean, so I said this on the Dan Deegan show, the Sales Chatter Live a few months ago, that freight leads everything. Freight leads everything, and I really should get that printed on a T-shirt, because we were at DATCon last week, and nearly every shipper I talked to said expect discounts around Black Friday, starting at Columbus Day or Indigenous Peoples Days for the first time in 3 years. Right?
Exactly. Yeah. Yep.
I'm having my coffee Monday morning. The lead story on the Today Show was Black Friday discounts are back.
Right. So, 6 weeks away.
Right. So, I think all in all, I think the fact that if we do see discounts, Amazon's having another Prime Day, Black Friday sales are starting early, I really do think that could be a boon for shipping volumes. And I'm going to rephrase that and be a little bit more assertive. It will be a boon for shipping volumes. I think as we progress through peak, the question becomes how willing are the consumers to spend? And if recent history is any indication, they are pretty willing to spend. So as this cycle sort of rounds the corner, we've done a lot of talks, 3 of them just last week, about the market cycle. It looks like the spot market cycle is rounding the corner and starting to think about going back up into the next cycle. Contract rates still have a little bit to fall, it looks like. It might be a good time for a shot in the arm to get some nice volumes moving around, to be honest.
And of course, Ken, that's all dry van. In the reefer market, we'll definitely see peak volumes heading into the holiday season. We'll start to see fresh turkeys start to move in a week or so. We've had a lot of volume of pumpkins moving around the market this time of the year. We're starting to see early signs of the shift in produce season from traditional regions into port markets like Philadelphia. We'll see some of the leafy greens start to come out of Yuma, Arizona shortly. So, and of course, tomatoes will start coming across the southern border in higher volume. So lots happening and lots moving in the market. So I think the produce carriers will probably see more of some of that traditional seasonal peak activity that we see between now and the end of the year.
I think that's right. It is bid season, right? I mean, we talked to a lot of we focused on the shipper feedback we got last week. Talking to a lot of brokers, they're inundated with bids right now. They're running more than they ever have. So, that's going to be something really, important to keep in mind of, is where we are in this freight cycle. I think, one thing that's been super interesting is just how how well the non-asset carriers have performed through the RFP environment, if you'll call it that, over the last few years. They've really been able to secure a lot more contract freight. And what has me super excited flying back from a conference like we had last week with shippers and brokers and carriers in the same venue was, we're in a room full of shippers, and we asked, raise your hand if you had a broker on your primary routing guide before COVID. I don't know what, Dean, 3 or 4 hands went up?
Yeah, at most. Yeah. And
then how many of you have a non-asset provider on your primary routing guide today? It was like the whole room. Right. It's like asking someone if they want chocolate, right? The whole room went up.
Right.
So I think the best we can tell in our data, which it's going to take a while to like fully flesh out, is up to 200, maybe 300 basis points of increased share for brokers on contract freight, which pumps an enormous amount of volume onto the right. You're talking about $500 billion by some estimates, $500 billion of $500 billion of for hire freight. Most, 90% of that's contract, 85-90% of that's contract. So if every 1 percentage point you can shift over is a lot of freight, which explains, I think, why you're still seeing a ton of load posts on the board compared to a down year like 2019.
Ken, one of the things that came out of last week's Shipper Roundtable was routing guide compliance. So, Bill Cassidy covered this in the Journal of Commerce last week when he spoke to me about the increased volumes that we're seeing in the spot market. And of course, if shippers are deliberately not putting all of their lanes into their routing guides, what they're essentially doing is engineering in more routing guide compliance, because you'll have those 1s and 2s lanes that don't move a lot of volumes. When they're excluded from the routing guide and they're going direct to the spot market through their non-asset providers, you're essentially increasing your compliance levels in the routing guides. And I thought that was a very interesting thing. That's part of the reason, I think, why we're seeing more volumes in the spot market. But what we'll be able to see, I think, is better routing guide compliance, because they're engineering in fewer failures.
Yeah, you're shrinking the denominator as opposed to the numerator, right? So I think, that's a point. And again, that is case in point why you should be looking at reputable and a diverse set of data providers, right? Because if you're narrow focused in on this data set that looks primarily at retail tenders for a specific subset of carriers, and you're basing all of your business decisions on that, you're going to have a very bad time, right? You're going to get I'm not going to say you're going to get an incorrect, but you're just going to get a hyper-focused view of one segment of the market and possibly make really bad business decisions based on that.
Yep. And that's why I looked at the load posts, because I was struck by the fact that they were almost double what they were pre-pandemic. That just shows you how much volume has not only moved to the spot market, but stuck in the spot market. It stayed there, even after the market went through the recovery.
Yeah, and that's the same advice I would give you, right? Don't base all your business decisions just looking at load to truck ratio, right? Wrap yourself in the context of all of the data that's available to you, both hard, numeric, quantitative data, and qualitative data, like talking to folks moving freight every day and reading things like Journal of Commerce or Supply Chain Dive, et cetera, et cetera. So I think that's probably where we are from a retail peak perspective. It might be less peaky, it might be more of a retail plateau, or a mesa. My son's learning geography, or not geography, but whatever that subject would be, where they talk about archipelagos or archipelagos and all that stuff. But it's a retail something. I wish we had a several hundred person copywriting department where we can come up with the bloodbath lines and all that stuff. We just can't be that creative as analysts.
Yeah. All right. Our production crew speaking in our ears live, so they can kill us up.
Yeah. Right. Say Cliff. It's an import Cliff. I bet you maybe we should get a bonus every time we say bloodbath or Cliff or something. Everybody just send $100 to our account. That would be funny. All right. Listener questions.
Yeah.
What do we got here?
What do we got?
So John had a question, and frankly, with all of the stuff with our trade show, I've heard this in like 10 different sources and from customers, and I haven't been able to dig into it. The question is, I understand barge traffic on the Mississippi is slower due to low water levels. It's reducing capacity at grain harvest time. Any impact on trucking? Everyone I've talked to said this is a really big deal, and they also said no one's talking about it. Are you tracking it, Dean?
Not at the moment, no.
So we'll go back and look at this, because I think it's something we need to investigate, because I can't believe how many times it came up and how unaware I was of it, to be quite honest. So it's a bit of a blind spot for us. We'll go take a look and maybe loop in some of our contacts that know a little bit more about kind of freshwater traffic, inland traffic. Yep. I have to imagine it's going to have an impact on trucking, because if they can't get it down the Mississippi, they're going to have to truck it.
Yeah, you see a lot of coiled steel move to a lot of riverside manufacturing plants up and down some of the key rivers in the Midwest. So I think it'll have an impact there. A lot of chemicals. You see a lot of barge traffic move chemicals, a lot of bulk commodities, so a lot of coiled steel. So we could see some impact. It's worth digging into in terms of if we're seeing any spot market activity along those river markets. I'll see if I can report on that next week.
Cool. So we have Davis has a question. Can you guys cover California to California spot freight? As I just stay in California, but could use DAT's great intel. California to California is a huge set of lanes for us, Dean. What do you think about that?
Yeah, absolutely. Again, I'll take that question on notice, Davis, and get back to you on that. It's something probably worth reporting on. I can cover that next week in our market update. So I've already made a note to get you an answer on that. A little bit more of a focus on that huge state.
Yeah, and Matthew Leffler is going to be on next week talking about some of the employment classification nuances with the AB5 in California from a legal perspective. So I'm really excited about that. I'm sure it's impacted the analysis that Dean's going to do.
Yeah. Ken, one of the things I theorized about when I was last on a show with Matthew a few weeks ago was that I could see if carriers stop going into California because they're worried about being caught up in the labour rulings, you could see a lot more freight moving from the bigger cities just out to the California border, so that carriers stay within California and then carriers outside stop at the border. So you could see a lot more of that drayage freight moving out to the border markets, whether it be out on the 80 or the 5 or the 40. Be interesting to see if that's a trend that actually develops over time.
Yeah, was it New York that surpassed California for Southern California, LA Long Beach for the first time as the busiest port last month?
It did. Yep. Again, second month in a row, actually. Yeah.
Yeah. So I think that's going to really change some of those dynamics as well. All right. So we're rounding the corner here. You want to start with plugs there, Dean?
Yeah. Again, as always, we're on the Sales Chatter Show with Dan Deegan, 9 a.m. Eastern tomorrow. Catch them on LinkedIn. Stephen Pettit's going to be on Landline Now tomorrow evening at 7 p.m. Eastern on Road Dog Radio. I'll be on with Jimmy Mack this Thursday on Sirius XM Channel 146, again, Road Dog Radio with Radio Nemo. The latest Freight Von podcast is out. Great story and feature with Rocky Garf, who's from Waymo Trucking. They're talking autonomous trucks. You can catch that on the podcast channel. DAT is going to be at TIA's Tech Innovations Conference, along with other innovators and industry analysts, October 26 to 28 in Phoenix. And of course, Ken's going to be on shortly with Chris Jolly on the Freight Coach Morning Show at 10:30 a.m. Central, 11:30 a.m. Eastern. Look for Chris Jolly, the Freight Coach, on LinkedIn. With that, it's back to Ken to wrap up the show.
Yeah, I'm really excited about being on with Chris. And I can't stress enough how great it was to see everyone. Every time someone came up to me last week and said that they tuned in on a regular basis, it was super humbling. I mean, this started with just a couple of us doing a live action whiteboarding session, poorly filmed. And I think one of the big takeaways is people really find this informational and helpful. So we're going to do our best to invest and make this the best that it could be. We're never going to have kind of a fancy studio or anything like that. But the real intent here is to be educational, to foster collaboration and learning within the industry. So to that end, we're going to really go back and see how we can improve things. But I can't thank everyone enough. I know it takes time out of your very busy week. It's during a very busy time in freight. All of our presenters that came down to take time to put together presentations. I can't stress enough how thankful we are and how great of an event it truly was. So thank you again. We will see you next Tuesday at 10 a.m. Eastern. I'll be coming to you live from Denver. I'm flying out there so that I don't get local heckling for wearing my Sparty jacket that Matthew sent me. We'll be doing our swag swap show, if you remember, Buckeyes for Spartans. We'll have him on, and I could not be more excited for the topics he's going to cover next week. I would mark your calendar for that show and come loaded to bear with questions, because it's going to be a unique opportunity to talk to him live. So with that, we're going to sign off. Have a great week. Have a safe week, and we will see you next time. Bye, everyone.
Bye, everyone.